Imagine two investors living on the exact same street in the UK. They earn the same salary, invest in the same index funds, and achieve the identical 7% annual returns. Yet, when April 6th rolls around, one of them hands over thousands of pounds to HMRC, while the other pays absolutely nothing. They aren't using shady offshore loopholes. They've simply mastered a legal sequence known as the Allowance Stack. Right now, the UK is experiencing the tightest fiscal squeeze in a generation, with tax thresholds frozen and investment allowances slashed to historic lows, just £3,000 for capital gains and a measly £500 for dividends. Building long-term wealth in a standard account has become an uphill battle against fiscal drag. If you invest without a strategy, the system is designed to quietly chip away at your compounding growth year after year. But the smart savers aren't panicking. Instead, they treat individual tax allowances not as isolated buckets, but as interconnected cogs in a single machine. Today, we are breaking down the exact blueprint they use to shield their wealth, structure their assets, and legally outsmart the system. To understand how to stack your allowances, we first have to understand the interplay between your two primary tax shields, the stocks and shares ISA and the self-invested personal pension, or SIPP. Most people view this as a binary choice. Either you save for today or you save for retirement. That is a mistake. The smart play looks at your current marginal tax bracket. If you are a higher rate taxpayer, earning over $50,270 a year, the SIPP is an incredibly powerful tool. Every pound you contribute effectively claws back 40% tax relief, instantly boosting your investing capital. But lock it away, and it is currently inaccessible until age 55, threshold that is rising to 57 on the 6th of April 2028. That is where the ISA comes in. With a £20,000 annual limit, it provides complete structural freedom, no tax on capital gains, no tax on dividends, and completely tax-free withdrawals at any age. The strategy begins by using the SIPP to actively reduce your taxable income below the higher rate threshold, and then funneling the resulting tax savings directly into the ISA. You are essentially using HMRC's own rules to fund your accessible wealth. But what happens when you maximize your ISA, or you have existing wealth sitting outside these wrappers? You land in a general investment account, or GIA for short. And this is where a massive technical trap catches out most investors. Because our capital gains and dividend allowances have been heavily reduced over the years, even a relatively modest portfolio in a general investment account will trigger a tax bill. If you hold a global index fund yielding just 2% in dividends, a £25,000 portfolio will breach your annual dividend allowance. To mitigate this, smart investors alter what they hold inside the GIA. They intentionally choose income distributing funds over accumulation funds. If you hold accumulation units in a GIA, the fund automatically reinvests dividends for you. However, HMRC treats these as notional distributions, meaning you owe dividend tax on them anyway. Worse still, when you eventually sell, you have to manually calculate all those historical reinvestments to adjust your cost basis, or you end up paying capital gains twice. Distribution funds keep your bookkeeping clean and completely visible. They prioritize holding low yield assets in the GIA, while keeping high dividend assets safely tucked inside their ISA or pension wrappers. They control their friction by controlling the asset placement. This brings us neatly to the core mechanic, the actual order of operations for stacking your allowances before the end of the tax year. Step 1 is your personal savings allowance. For a higher rate earner, the first £500 of interest on cash is tax-free. For a basic rate earner, it's £1,000. In a world of higher interest rates, the smart investors keep their emergency cash exactly at this threshold, moving any excess into a tax-free cash ISA or premium bonds. Step 2 is utilizing the small remaining allowances in your GIA before they reset on April 5th. You cannot carry them forward. If you don't use them, you lose them. Smart investors will intentionally realize up to £3,000 of capital gains each year just to reset the cost basis of their investments, ensuring that future growth starts from a higher benchmark. But how do you move money from the vulnerable tax environment of a GIA into the safety of an ISA without triggering a massive tax hit? You deploy a specific tactical maneuver known as a bed and ISA transfer. Legally, you cannot simply transfer shares directly from a GIA account into an ISA. They must be purchased with cash inside the wrapper. A bed and ISA transaction automates this process. You sell the investments in your taxable GIA account, move the cash across into your ISA, and purchase suitable assets within the tax-free wrapper. Normally, if you sell shares and buy back the same shares within 30 days, HMRC's strict share matching rules kick in. They treat it as if you never actually sold the asset, preventing you from artificially using up your capital gains allowance. But here's the loophole. If you are buying the same holdings sold within your GIA, within your ISA, because the repurchase happens inside the tax-sheltered environment of the ISA, the 30-day rule does not apply. It is a perfectly compliant, fully recognized legal carve-out. When you piece all of this together, the maths becomes incredibly compelling. Don't mistake stacking your allowances for minor tax tinkering. Done right, this precise order of operations completely transforms the long-term growth of your wealth. It is the structural difference between constantly swimming against the current fiscal drag or having a permanent tailwind behind every single pound you invest. Let's look back at our two investors over a 20-year horizon. The first investor left their portfolio exposed. They didn't think a tiny bit of dividend tax or the occasional capital gains hit mattered in the grand scheme of things. But by letting those small leaks persist outside a tax wrapper and leaving their cash exposed to inflation, the system did exactly what it was designed to do. Over 2 decades, that compounding leak didn't just cost them a bit of spare change. It cost them over £80,000 in lost returns and unnecessary payments. That is wealth that belongs to their future completely wiped off the table. The second investor, however, systematically built the stack. They treated their finances like an interconnected ecosystem by using their SIPP to lower their tax bracket, maximizing their ISA wrapper, deploying bed and ISA transfers to clear out taxable gains before April 5th, and keeping their cash interest precisely under the threshold. They kept 100% of their return. They didn't need to find a magic investment or take on reckless risks to beat the market. They achieved a superior return simply by refusing to lose money to friction. HMRC doesn't make the rules easy to follow. And frankly, that's exactly how the system trips you up. But the rules are transparent. They're written down for anyone to read. The difference between financial stagnation and true financial freedom isn't how much you earn. It's how effectively you arrange the pieces on the board. Sorting out your asset placement and stacking your annual allowances isn't something you do once and forget about. It is a continuous, year-round habit. The UK system might feel like a maze designed to catch you out with frozen bands and endless paperwork. Once you know where the levers are, you can start making legislation work for you rather than against you. But optimizing your ISA and SIPP is really only the first layer of defense. If your career is progressing and your income is climbing towards that 6-figure mark, you are about to run flat into the system's most brutal hidden trap, the personal allowance taper. It is a phantom tax bracket that quietly gives middle earners a devastating 60% haircut on their hard work without them even realizing it. To see exactly how that trap operates, and the precise legal vehicles you need to deploy right now to bypass it entirely, click on the video on your screen right now. See you there.